Okay, let's get going. Welcome everybody to the June 14th edition of the Fats, Fuels, and Oils webinar. This week we're going to talk a little bit about fats and greases and bleachable fancy tallow or tallow, I guess more generally. And then we will go through our usual talk about what's going on in the biomass-based diesel with margins and credit prices. So not really that much going on this past week. We're kind of a little bit in the summer doldrums, I guess, maybe a bit. And then B, I think that we are between sort of big reports, although the WASDE report came out last week. The June report typically is not one that is that has a lot of big changes in it because we get the new crop balance sheets in the May report, and then we don't get unless there's something really crazy going on like the flooding in 2019. USDA typically doesn't make changes to their production forecasts until the August report. And so this report was very much like that, with some adjustments in the old crop balance sheets, but not much going on in the new crop balance sheets. And the adjustments to the old crop balance sheets, I think, are generally, if you're paying attention to the monthly data, not super surprising. So for soybeans, they took US exports up to 2.17 billion bushels, which is a little bit above where we are, but we think that probably there's some upside risk to our forecast, and probably maybe even some more upside risk to USDA's forecast. The only thing is we're kind of in a little bit of a lull in shipments. If you look at the way that our forecast is structured, it kind of suggests that over the next month or so, shipments remain relatively muted, and then really start to pick up in late July and early August as China sort of transitions away from Brazil, maybe a little bit earlier than they usually would because of the short crop in Brazil, and transitions to the US. That should help support old crop soybean futures, and then as a result, it should also support old crop soybean oil prices to the extent that they're not already being supported by gains in energy or growing demand from renewable diesel producers. But outside of that, there hasn't really been that much going on. This week coming up, we will get the monthly EMTS data for May. And so that'll provide a glimpse into what biodiesel production is doing, which will be interesting. Biodiesel production has been relatively steady, and we haven't really seen drop off in the biodiesel capacity that I think many have expected for a long time. And I also think that the renewable diesel number will be particularly interesting to us because we're predicting a pretty big month-over-month increase. And so if we don't get that month-over-month increase this month, I think it probably will probably take down our renewable diesel forecast for 2022 by a little bit, just because the seasonal pattern will kind of not fit very well if this month we don't get that increase. And it will also kind of suggest that maybe some of the plants that that we think have opened recently probably aren't operating at the levels that we thought that they probably were. With that, let's get on to talk a little bit more about tallow. So you can see our price forecast for tallow, generally pretty steady. I think we've got a range of sort of 2 cents plus or minus the current price, which is a record. and just below 80 cents for most of the rest of the year, before we get this little peak here in October, and then we get kind of the decline in the last couple of months of the year, which somebody was asking about last week. And I've looked into that, and it turns out that what that seems to be a function of, on some level, some of our forecasts are mathematically driven, and so there's the last stage is me looking at the forecast and seeing if it makes sense, or maybe more correctly, to see if it doesn't make sense. Outside of that, on some level, there are times when the forecast does something like this where I kind of think, well, why is it doing that, rather than thinking, oh, I know that this is exactly why it's doing that, and I've structured the forecast to reflect some particular development or seasonal pattern or something like that. Anyway, what I think is going on here is that you have the seasonal pressure in the fourth quarter that comes from soybean harvest, and on top of that, you have the completion, or at least the anticipated completion, of some expansion of soybean crushing plants and soybean oil refineries. And then layer over on top of that the fact that a lot of the new renewable diesel plants, even those with pre-treatment capacity, are relying more on RBD soybean oil as they get started than I would have thought maybe 3 months ago or 6 months ago. And so as a result, what you've got is a little bit of an increase in supply, or relatively, I suppose, significant increase in supply relative to the summer months. And then because there's more soybean oil around, and because more of the plants are using soybean oil, a little bit of a decrease in demand in the fats and greases, and that has shown up as a relatively larger decrease in prices during the fourth quarter than I think you would normally expect. And to be honest, I think that it's not far enough out of bounds that I really want to adjust it, and it kind of all makes sense when I think about it the way that I just explained. But it also wouldn't surprise me if prices were end up being a little bit higher than we're projecting. I think really the bottom line on all of our price forecasts, until further notice, is they are what they are. But I guess for most of them, they come with more upside price risk than we usually have, and in some cases more upside price risk than I've probably ever seen in my career. And so again, while I'm not uncomfortable with this forecast, it also necessarily wouldn't surprise me if we get to the fourth quarter and prices are a little stickier at higher levels than our models are suggesting. Okay, so that said, wanted to look at our tallow calendar year balance sheet and point out a couple of things. One of the things really that there are really two things of note fundamentally, and that have been going on in tallow. And one has been the big year-over-year decrease in the tallow yield per head of cow or cattle slaughtered. I think we talked about this last time we talked about tallow, and it really is noticeable. It's probably 20% or more, especially over the last couple of months. And that makes a significant difference in the production forecasts. And so you can see from 2021 to 2022, we're expecting a relatively large decrease in production, and that's really driven by the fact that that slaughter is maybe down a little bit, but I think the bigger driver there is really that yields so far this year have come in well below where we've expected, and we have kind of continually adjusted them down each month that we get in new data. And so think now we probably are at a level that's as low as we can go and as low as seems reasonably possible. So I don't think there'll be further adjustments down. But it's something that, given the price, given the fact that tallow's at record levels, is a little surprising. And I've asked around a little bit. Nobody really has a great clear answer to it. My easy answer to it is that in some sense tallow is part of the fat around cows, and with beef prices where they are, maybe it makes sense to keep a little bit more of that fat on the cut of beef. Now, maybe there will be somebody in here in the beef processing industry that will tell me that that's stupid and that doesn't make any sense at all. But outside of that, I can't really think of a great reason for the the huge difference year over year in tallow yields. Now, it may be that there's something to do with the way that the cows are fed or the cattle are fed, but I think generally they're still being finished in the same way that they typically are finished, and so I wouldn't expect that that would have a huge impact. So again, until somebody tells me a reason with some real confidence, or tells me that I'm completely wrong, I'm kind of going with the idea that with beef prices where they are, that makes the fat worth a little bit more as well. And so not quite as much as getting diverted into the tallow stream as we would usually see. The other thing of note that's interesting, I think, is the increase in tallow imports. So several years ago, we kind of set up a model to forecast tallow imports that looked at beef production around the world, and then based on anticipated yields, tallow production, and then tallow exports based on historical trade flow data. And that model has worked really, really well until about halfway through this year, or the first couple of months of this year. And certainly over the last couple of months, it has been really, really low relative to what we've gotten in, so much so that we went back and revamped the model and kind of did a refresh on everything to try and get the projected numbers to line up more closely with the trade flows that we've seen recently. And even after that, we still are a little below what has come in recently. Now, we haven't gotten any new data since we did the refresh on the model, so we'll see what next month's data tells us. But the growth in tallow imports seems to be significant, and it is probably an area that over the next 3 to 6 months, we probably will spend a little bit more time diving into a little more deeply in developing real balance sheets for some of the major tallow producers around the world. Right now, kind of the way we do it is we look at historical cattle slaughter, then we estimate forward cattle slaughter based on some estimation for basically per capita GDP. And then, like I said, we take a yield and that gives us production. And then we look at basically how much has historically been exported and how much of those exports go to the US. And that's kind of been it. That differs from the way that we do a lot of, say, soybean oil exports. So for soybean oil, we have balance sheets for all the countries around the world, and we look at trade flow patterns for around the world, and we have a trade matrix where we kind of match up the exporting countries' supply with the importing countries' demand, so that everything kind of balances out and ultimately makes sense that way. Tallow, we probably will drive a little bit closer to the soybean oil model than the tallow model that we currently have, just because there's been such a big departure from the model that we have, and because in theory the differences that we see could be a significant portion of the overall feedstock supply. I mean, it's not going to be billions and billions of pounds, but the differences have been 30 million pounds a month or so. And so at the end of the day, that's 360 million pounds of additional supply that that I think we probably weren't tracking as well as we should have been before. So I'll keep you updated on how that goes. And if you have questions about tallow around the world, please let me know, and that will kind of help us decide where we direct our resources. The final thing I would say about tallow is on the export side. We've seen a pretty sharp reduction in exports year over year. Again, that's probably not surprising. We expect that for a lot of the feedstocks, and we try to take exports down to levels that we think make sense. Typically, there's some sort of minimal level of exports that are going to continue, even given the big growth in demand from the biomass-based diesel industry. And I think it looks like tallow is kind of going through that. And I think if memory serves, I think tallow exports are off like 20 or 30% sort of year over year at least. And so I don't know, I don't have a great sense for exactly how low tallow exports can go, but I think we've kind of set 350 million pounds a year as our initial target. And then I think this year probably will give us some good insight into whether that level holds or whether exports will be ultimately lower than that kind of going forward. All right. Outside of that, again, not a lot going on. I think the fat and grease markets have been kind of slow for a little while now, in part because prices are where they are, in part because I think there still are some logistical issues that are making trade more difficult, and in part because I think at least the last time I checked, some of the bigger buyers had not been participating in the markets to the extent that I think we thought they would at this point. I don't have a great sense of whether that's, well, I guess I assume that's because they already have their coverage on. I certainly don't think that they've shut down their plants, but I assume that in part that's because they already have their coverage on, and at record prices, they're trying to wait to see if prices will break before they extend coverage further. And so this might continue for a little while, at least until maybe we do get that break in the fourth quarter, but we'll see, and I'll keep you posted. All right, on to biodiesel, biomass-based diesel. And in general, gross margins, our margin estimates kind of continued the same trend that we saw last week, where biodiesel margins declined and renewable diesel margins rose a little bit. Credit prices were offsetting. We had further declines in LCFS credit prices. Those were offset by small increases in RIN prices. They were each about 8 cents a gallon. Basically, LCFS went down by 8 cents a gallon, and RIN prices went up by about 8 cents a gallon. So that kind of offset. Most of the feedstock prices were generally steady. The only increases that we really saw were for soybean oil and one of the fat, and I think tallow was the only other increase that we saw in feedstock prices, and the tallow increase was relatively minor. So it left it to basically the changes in fuel prices to guide the move in the margin calculation. And we had a kind of steady biodiesel prices, and I think we had a little bit of an increase in renewable diesel prices that explain the change. Now, we expect, despite the fact that biodiesel margins have been negative and more negative than we were forecasting by quite a bit, and they were like negative 16 cents by our calculation with credits last week. We expect that biodiesel margins will recover and will remain well supported through the end of the year, again, because of the relatively large gap between ethanol production and the ethanol mandate that we think means that there will be demand for biomass-based diesel. The question remains, though, whether that demand will be met by biodiesel or renewable diesel. If renewable diesel margins are going to be that much greater and are going to be well supported over the next month or two, or over the next quarter or two, I guess, probably more accurately, and biodiesel margins are going to continue to come in where they have been coming in, then it sounds like our biodiesel forecast is probably going to be too high, and our renewable diesel forecast is going to be too low. I would bet that it's the opposite, and so far this year, our biodiesel, our monthly domestic biodiesel production forecasts have been low. So it's hard for me to see a reason, at least at this point, outside of the negative margins, to cut my biodiesel production forecast going forward. But again, we'll get some data on Thursday that may change all that. For renewable diesel, again, we expect margins to remain well supported at the current level, or relatively close to the current level. I think it's, they call it about 275 a gallon with the credits, and we expect that pretty much through the end of the year. We've got energy prices remaining about where they are, maybe moving a little bit lower as we move through the end of the year. Of course, I think there's probably a significant risk to the energy price outlook, given the increasing concerns about a recession and the increasing probability that the Federal Reserve hikes interest rates by 3/4 of a point at this week's meeting, and then maybe 3/4 of a point at the next meeting. It seems like there have been a lot more sort of media reports that that's the path that they're going to take, as opposed to the 50 basis point hike path that Jerome Powell laid out during the last Fed meeting. If that's the case, it seems like maybe the economy could slow some, although I still think that that structurally it seems like energy is just short. And so it's hard at this point to say that, oh, we're gonna take our forecast down substantially from where they are because of this potential recession. It probably is going to be something where we're going to react more to the numbers as they come in, as opposed to really having some deep insight into what's coming next. Just because, one, it's been, I guess it was, I read something the other day that I think the last time the Fed hiked by 0.75% was 1994. And so it's been quite a long time since the market or the economy has had to deal with this kind of interest rate environment, or this kind of rising interest rate environment. And it's not, if it was just that, it would be unusual. But then you also have the war in Ukraine and everything else. And so it's very difficult to kind of, I think, project energy prices with any real confidence. And so we're kind of going by what we think is going to happen, and trying not to get too far out over our skis with any real big predictions one way or the other, either much higher or much lower. We're trying to kind of stay in the middle of the road, basically, going forward. But of course, that number will have a huge impact on what margins looks like going forward. All right, another thing that are RIN prices, and this week we adjusted our RIN forecast down just a little bit. The spread between D4 and D6 continues to narrow. I think it's at like 12 now, or somewhere close to that, at least the average for June. And so we narrowed the spread a little bit, but we took the forecast down slightly out in the fourth quarter in September in December more than anything. We took September down just a touch so that the peak is just a little bit lower than it was last week. And that's due in part to the fact that what we've seen is a pretty sharp move lower in the HOBO spread, in part because you've seen this sharp rise in energy prices from sort of around $100 to $120. And at the same time, you've had soybean oil prices holding kind of steady around just over $1.05 for RBD in Chicago. And as a result, RIN prices probably don't need to do quite as much work as they would if soybean oil had rallied with energy prices over the last several weeks. And so I don't expect that we'll take the forecast down significantly from here, in part because we've already got a relatively narrow spread on D4 and D6, and D6 seems to want to follow the path, or at least relatively close to the path that we're projecting. And so it's hard to take D4 down much from here. And the concerns about the ethanol blend wall are real. And so it's for that reason, it's also hard to find a great reason to take D6 down. And if we don't take D6 down, it's very hard to take D4 down much more than we already have. Now, LCFS is not that way at all. And we cut our LCFS forecast by another $5 a metric ton, pretty much across the entire forecast period this week, as prices continue to move lower and dropped below the lower end of the range of our forecast for June. And so now I think we've got LCFS prices bottoming out somewhere around $70 before they start to catch and move up in 2023. Again, we have a hard time sort of trying to say with any real confidence where we think that low is, but we still do believe that that prices will start to recover in 2023. All right, with that, I'll open it up if anybody has any questions. If not, we will actually get done a little early today, which is very unusual. All right, no questions. Okay, everybody have a great week. Next week we will have the webinar. I don't know if everybody's going to be off next Monday or not. I'm pretty sure that we are, and I think the markets are closed next Monday too, in observance of the Juneteenth holiday, which I think is a federal holiday now. So I think the markets are probably going to be closed. Either way, since we've had sort of spotty webinar coverage over the last month or so, we're going to have the webinar on Tuesday. But like I said last week, it just may be that we don't publish the report until after the webinar instead of before the webinar. All right. With that, everybody have a great week and great weekend, and I will see you next week.